bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough exercise on how to properly analyze and journalize transactions using the all clear system. So if you're unfamiliar to the all clear system, don't fret. I'll drop a link to a video that'll get you up to speed with no time. So without any further ado, let's get it. So, as a manager of Margarita Mexican, that's what I'm talking about, you must deal with a variety of business transactions. Provide the explanation for the following. Okay, so they give us some transactions and we need an explanation to support what the proper accounts that are being affected. And we're going to use the all clear system. So quick summation, all clear is two gains: assets, withdrawals, and expenses belonging to all gain. And clear gain is basically your capital, which happens to be stockholders' equity, liabilities, and revenues. If it's in the all gain, it's going to always increase with a debit, decrease with a credit. If it's in the clear gain, it's always going to increase with a credit, decrease with a debit. So, first transaction, debit equipment and credit cash. So, how are we going to attack this, gang? Equipment happens to be an asset, and cash happens to be an asset as well, which means both of those accounts are in the all gain. Now, since we're debiting equipment and equipment's in the all gain, we already know that we're increasing equipment. Likewise, because cash is an asset and that's in the all gain as well, we're crediting it, which means that cash is going down in the business. So, what happened in this transaction if we increased equipment in the business at the same time decreasing cash? Well, let's see. So, move this right here. Pay cash for stock dividends? No. Purchase equipment for cash? Here we go, gang. This is the correct answer. Moving on. The next one tells us that we debit dividends and credit cash. Okay, so we already know, gang, from the first example that cash is an asset, which means it's in the all gain. Since it's in the all gain and it's being credited, it must be going down. But what about dividends? Dividends is being debited. Since dividends is being debited and dividends constitute as a withdrawal from income in which the company gives to the shareholders, then we consider that to be a part of the all gain. And since we're debiting dividends, that means dividends are increasing in the company. The company has given more dividends. So we've increased our dividends at the same time decreasing our cash from the company's perspective. So let's see what transaction that is. Clearly, we already know we're paid cash dividends to stockholders. That is your correct answer. Moving on. Debit wages payable and credit cash. Again, we already know, gang, cash is a part of the all gain, which means that if we're crediting it, it's going down. So cash is decreasing in the company. What about wages payable? Last name payable, which means it's a liability. And since it's a liability, we already know what gain that one belongs in, the clear gain. What are we doing with it? We're debiting wages payable. So, based on the clear gains rule, if we debit it, that means we are decreasing our wages payable, ultimately decreasing our liabilities. So our wages payable went down, at the same time causing our cash to go down. So what situation happens when your cash goes down as well as your liability? You already know. So the correct answer would be paid wages owed to employees previously recorded. Moving on. The next one tells us that there's a debit to equipment and a credit to common stock. Okay, equipment is an asset and it's being debited. So because it's an asset, it's in the all gain, and we know if we're debiting anything in the all gain, it's going up. So equipment is increasing in the business. What about common stock? Common stock is a part of stockholders' equity. And stockholders' equity is also known as capital, which brings it to the clear gain. And since it's in the clear gain and it's being credited, we know that common stock is increasing in the business. So ultimately, Equipment is going up as well as common stock. So what transaction will constitute equipment going up as well as common shares being issued? Clearly, we received equipment for the business in exchange for common stock. Moving on. Debit cash and credit unearned revenue. So we already know, gang, cash is in the all gang, and since it's being debited, it's going up, so cash is going into business. What about unearned revenue? Now, the title is misleading because of the last name, revenue. However, unearned revenues are created when a company collects cash in advance for a service to be provided in the future, which ultimately means the revenue hasn't been earned yet. Since the revenue hasn't been earned yet, while the company received the cash simultaneously, we have to create a liability. So what am I saying? Unearned revenues are liabilities, things that the company owe. So, because cash is an asset and it's being debited, we know it's increasing in the business. And since unearned revenue is a liability, it's in the clear gain. And since it's being credited, we know that it is also increasing as well. So ultimately, our cash went up as well as our unearned revenue liability. So let's see what transaction would that constitute. There it is. Receiving cash from customer for work to be completed in the future. Keyword in the future. Moving on. How about a debit to advertising expense and a credit to cash? I feel already my spider senses are tingling. Y'all know what to do.
Just do it.
We already know what gain the advertising expense belongs in. It's an expense, so therefore it should be in the all gain. We're debiting it, which means that expense is incurring or happening, thus increasing expenses for the period. What about a credit to cash? Cash is in the all gain as well, and we know when we credit cash, it's going down. So what have we done? Think about it. Expenses went up while cash is going down. Clearly, we know that we've paid for advertising with cash. And last but not least, a debit to cash and a credit to service revenue. Cash is in the all gain, it's going up. What about service revenue? Revenue is in the clear gain. Since revenue is in the clear gain, we automatically know that any account in the clear gain will increase on the credit side. So thus, we have cash going into the business as well as increasing our revenues. Remember, gang, revenues can only be created whenever you provide a service or sell a product. So let's look at the right answer. Obviously, we perform services and we're paid by the customer. Let's check our answers. Bags all day. So you see how easy it is if we apply the all clear system to the transaction analysis? It makes everything all clear. Hopefully that light bulb clicked as we went through this exercise. And if so, don't forget to like, subscribe, and share the channel with your friends so they can chase the bag. Don't be stingy. I'm Dr. Who, and it's always my humble pleasure to have you guys spend your time with me. And I look forward to seeing you soon. Bags.